Hey everyone, Meet Kevin here, coming to you on April 21st with a breaking news update from the Federal Reserve and the Federal Housing Finance Agency on what's going on with the crazy and evolving mortgage crisis and possible housing market crisis to follow. Let's get into that on today's Meet Kevin Report, where I report news that makes you money. As of last week, almost 6% of individuals, 5.95% of mortgage holders have entered into forbearance agreements, agreeing not to make payments for the next 3 to 6 months. We've also seen that a lot of those folks entering into mortgage forbearance agreements are seeing their credit scores plummet by ranges from 30 points to 50 points to 75 points as credit bureaus are picking up on notes that say, sorry, your account is in forbearance, and the credit bureaus don't like that. All of these things are combining to start making a lot of us feel a little bit worried about real estate. After all, when we look at new construction housing starts, we see they've plummeted to record new lows. We see sales volumes declining 20 to 30% in the first 2 weeks of April across various different parts of the country. However, prices are tentatively remaining stable, at least when we compare pricing today to pricing in January in many markets across the country. We see pricing relatively flat, which is a good sign so far, but what does it mean for the market to come? And what is the Federal Reserve and the Federal Housing Finance Agency doing to minimize the damage? Well, in order to get a glimpse of what the Federal Reserve is thinking, which remember, the Federal Reserve puts data together and they give that data to the government so the government can decide what do they want to do to help people like us and what's it going to mean for housing prices. Well, the Federal Reserve Bank of Richmond yesterday published a briefing that said, all right, let's run some projections. Let's say that unemployment stays at 20% throughout 2020 and into 2021. If that happens, the Federal Reserve Bank of Richmond thinks real estate prices without intervention will fall by 15% through 2025 and will then rebound. This is one of the most dark and dire projections we've seen yet. Well, so far, we've seen that Freddie Mac thinks prices will actually be relatively flat, positive 0.4% and 0.7% in 2020 and 2021. But the Federal Reserve Bank of Richmond is looking out at the long-term consequences of what this Rona crisis and high unemployment might actually cause going into 2022, 3, 4, and 5. And look, 15% isn't as bad as the 25 to 35% declines we saw during the Great Recession or the 45% declines we saw in commercial multifamily real estate during the Great Recession. 15% is still bad. And using 15% as a price decline, the Federal Reserve Bank of Virginia found that, all right, we might, in a favorable case, see losses in excess of $420 billion if prices decline 15% after these mortgage forbearance periods. That's a lot of losses. In fact, I'm going to compare these losses to Chase to kind of make us be able to picture these a little bit better. Their base case scenario was $580 billion in losses, and the severe case showed $1.1 trillion in losses if prices decline 15%. Which, just to compare these losses so we can kind of predict how bad the mortgage crisis would be, it's helpful to compare these losses to Chase and their share of the mortgage market, which, don't worry, I ran all those numbers for you. I looked up their annual reports, their net income and consumer banking, all of that. Bottom line is, if these losses happen, Chase Bank would basically be working for free for consumers between 6 months in the favorable case and up to 24 months in the severe case, working completely for free. That's like, no, revenue didn't go down 10%. That's working for nothing for the next 6 to 24 months. So this is bad. And that's only referencing Chase's share of the mortgage market. If Chase lost somewhere between $8 to $30 billion in mortgage losses, yeah, they'd be working for free in consumer banking for 6 to 24 months. That's really bad. But think about this. Over 60% of mortgages are actually originated by companies like Quicken and Mr. Cooper and other online non-bank mortgage brokers. So they would be suffering pretty substantially as well. Fortunately, though, the government is responding finally to the growing mortgage crisis. But to understand how the government is responding, let me give you this quick primer here. This is you and me. When we stop making our payments, that is, we do not send the bank our money, and that does not happen, the bank still has to send these rich bondholders money. And they have to do that forever until they basically write this loan off the books, which basically means taking a loss on this and writing it off. They keep paying the rich dude. Well, this is a lot of money that banks have to keep paying the rich dudes, and that's why the banks are trying to screw people's credit for asking for forbearance. They want less people asking for forbearance. It kind of makes sense. Well, finally, we've had the government swoop in and go, don't worry, we're here to help. And so they said, no worries, you're only going to be required to send money to the people who hold those mortgage-backed securities, the rich dudes, for 4 months. After the 4 months, we will pay the rich dudes. This is really, really good news for 2 reasons. 1, it limits losses at banks, which when banks have less losses, it means they keep credit flowing. It means they don't necessarily tighten their lending standards, even though a lot of them already have. They might relax those standards again. And it also means they might freeze less credit lines. And anytime banks keep their lending guidelines looser, it means we have more money to be able to borrow or build businesses with or finance investing activities or whatever with, so that we can actually grow the economy. So even though this kind of seems like a bailout, I mean, that's kind of exactly what you could call it, a bailout, it allows the banks to be looser and less restrictive with us. Hopefully it also means they're going to stop screwing our credit for asking for forbearance. And we in turn, since we make up 70% of the market as the consumer, we're the ones making up 70% of the market, not them, then hopefully we can get the whole engine moving smoothly again. So this is a really, really good thing. This is the government coming in saying we do not want to see 15% declines in real estate. In other words, it's not fair to say, hey, let's crash real estate because this unforeseen pandemic happened that made 20% of people lose their jobs like overnight, and now banks have to tighten up and start freezing their money and increasing credit requirements. They're trying to resolve that, so this is good news. But the good news actually doesn't end there, because Fannie and Freddie and regulators are actually in talks to do something that hasn't been done for quite a long time. Fannie and Freddie are in talks to potentially buy homes directly from people in mortgage forbearance. That is, if you're under a mortgage forbearance plan and for some reason you're close to what you owe on the house, or you know what, you just need to get out, Fannie or Freddie might come in and replace that typical buyer supply and make an offer on your property. This has not happened yet. This has not been approved yet, but this is in talks. Because remember, a big thing that a lot of us are worried about is we're thinking, well, Kevin, buyers can't get loans because banks are tightening credit standards, which this last thing we talked about helps. That softens, hopefully, credit standards. That's good. But we still have this concern that, well, if people are not employed, that means we have less buyers. And so if we have, let's say, 40% less sellers because less discretionary sellers are selling, but we have 56% less buyers, that's bad. That's a bunch of BS. That means we have a net void of 16% less buyers in the market. But if Fannie and Freddie come in and say, don't worry, we'll be that 16% for you. We'll balance the market out to do what? Stabilize prices, which is kind of the goal of the Federal Reserve anyway. Maximum price stability and maximum employment. That's like their motto, whatever, mission statement, whatever you want to call it. This could actually work. But the big point of all of this is to say that your prospects for building wealth through investing in real estate might stay strong through this crisis. I know a lot of us are fearful right now. We don't want to buy. We're not sure if we want to go buy wedge deals below market value because what if the market free falls? These stops before prices start falling are really, really good. And they make me feel happy because, again, I look back at being 19 years old and having no net worth. Like I'd save money working at Jamba Juice and I'd go buy a beach cruiser because I'm like, oh, I finally have some cash. Let me go blow it on something. How am I ever supposed to build wealth thinking like that? And it wasn't until I got involved in thinking about real estate and investing in stocks that I actually started building wealth. That's what I teach you, by the way, in my real estate program, which I highly encourage you to join. I've also got one on money. We talk stocks and real estates every day. The market's open at 9 a.m. Really encourage you to join me. But the most important thing out of all of this is we know that the Fed and the government are keeping an eye on real estate as well. Right now, we've got a lot of energy and focus going into stimulus checks, a lot going into small businesses, a lot going into airlines and bailouts. We haven't yet seen much in real estate other than a lot of banks tightening their standards and freezing credit lines. This potentially reverses that course. And while we don't yet have updates on what's going to happen with people asking for forbearance and the end results of their credit score, and there are a lot of unanswered questions, this is the optimism that I want to see in the market, especially at a time when there's nothing but negativity and fear-mongering going around, specifically around oil prices, which I'm just going to take a quick moment and say, I don't care about oil. I really don't. Now, I'm not trying to say that to say I don't care about a lot of people who are going to lose their jobs because oil is now at a point to where it doesn't make sense to operate an oil refining or fracking or drilling business. No, I totally feel bad for the people who are going to lose their jobs with cheap oil. I'm not saying cheap oil is a good thing at all. It's traded in the petrodollar. It causes a lot of issues. This is just to say that, of course, a May contract for oil is going to be pretty dang worthless. Nobody needs oil right now. There are so few people traveling. There are so few people driving. There are so few people using oil, gas, or kerosene right now that, of course, the May contract is going to look negative or zero or whatever. Of course! However, the oil market to me is short-term thinking. The real estate market is the long game, and that's where I want to focus my attention, is understanding what's happening in the real estate world and what are my expectations in terms of what's going to happen with pricing. I'm personally thinking we're going to see real estate prices soften 4 to 8% by August. However, this backstop could help us soften that blow even more. Let's see, let's keep our fingers crossed. Let's learn how to buy wedge deals. Let's get educated while we're stuck at home. Join me in those courses down below. Get your 2 free stocks with Webull when you deposit just $100 with the stock trading platform Webull. You'll get 2 free stocks valued up to $1,400. Finally, get some life insurance and protect yourself in case the unthinkable happens. At least your family can be well off. And folks, we'll see you next time.